Hello, my name is Chris Head and I lead our work with clients at the Asset Management Exchange. And I'm here with my colleagues Elaine and Nick to talk about good governance and some gaps that we see in governance today.
Hello, I'm Elaine Russell and I work with our clients who have onboarded onto the AMX platform.
Hi, I'm Nick Horsfall and I work with our prospective clients.
Today, we'd like to share 3 topics with you around the topic of governance. The first is what, in our view, great governance is, and Nick will be picking up on this shortly. Second, we'd like to share some governance gaps, and Elaine will be describing these. And then we'd like to wrap up with our view on how technology is solving these governance gaps for trustees and investment consultants. So let me start off. Nick, you've worked with pension schemes for some time. You've provided investment advice. What in your mind is great governance?
Okay, Chris. So paying in pensions is really, really important. There are millions of people who rely on those pensions for stability in their retirement. And therefore, running a pension scheme is important. So what is governance? Governance is just the framework by which the pension scheme is run. And good governance is basically managing those pensions in a good or great way. Lots of different people have views about what great governance is, but the Pensions Regulator have really helpfully outlined what they think good governance is, and in our opinion that is a great starting point for pension fund trustees and professionals to look at. What they've done is they've outlined things you should consider, those being resources, mainly people, processes and structures. They've also put together some practical examples that people can look up on their website. One thing they ask trustees to look at is to try and assess the risks in their pension schemes, and they suggest maybe putting together a risk register, which by going through that you can assess the bigger and the smaller risks. The bigger risks which are quite obvious, such as the scheme sponsor failing, asset returns being appalling or fraud, and some smaller risks as well, Chris.
And within that construct, where do you see trustees spending most of their time, and perhaps more importantly, where do you see them not spending a lot of their time?
So if you're a trustee, the really, really important things to do are, it seems obvious, but pay pensions and benefits on time to people, they rely on them, and also do things like withhold the law and apply the law to the scheme. And trustees and pension professionals basically do that pretty well. They would then focus on the other major risks which they need to look at, and I've outlined some of those. Will your sponsor go broke, getting the contributions in time, are asset returns going to be appalling, getting the asset strategy right, will there be fraud, getting frameworks in place to make sure there isn't fraud. And that is all a lot of time to do. But there's a whole list of other risks. Some of those are considered smaller, such as operational risks, but they can make a real difference to a pension scheme the way it's run, Chris.
That's an interesting area. And Elaine, you interact with our clients on a daily basis. You hear their concerns. What are these operational risks that Nick is speaking about?
Yes, so we see 5 areas of operational risk that are really key to our discussions with clients. So these include areas such as effective treasury management. So by this, the focus here is on looking at whether there's excess cash on the portfolio and whether that has been efficiently managed. Another area could be fund liquidity. So is the liquidity of the fund being managed in accordance with the investment strategy, but also in line with market conditions so that clients can make good the financial obligations as they come due. We're also looking at cost and tax. So it's increasingly important that our clients understand all of the costs associated with their fund, not just the high level ones, and that will help them make informed decisions. Then there's also mitigating trading errors. So by this, there's an understanding that trading errors will happen during the course of buying and selling assets, But it's really important to be able to both report on them and also get them refunded. And then finally, the fifth area we would look at is looking at our market counterparties. And that's recognising that the fund might not always be managed by the investment manager. There may be market counterparties such as prime brokers and future clearers that are involved. But there's a risk there if you're not also monitoring those counterparties in line with a risk-controlled framework.
Well, I'd like to come back and go through each of these very briefly. But before we do, I think, Nick, I'd like to come back to you first, which is why are not investment consultants and trustees looking at these risks today?
Chris, I think it's just down to time and resources available. So if you think the average trustee board probably meets 4, maybe 6 times a year, an investment committee similar amounts of times, and most trustees running a pension fund, they're doing it not as their full-time job, but as part of their job. So it really is just the amount of time they're able to put into it. There are other things to consider about their knowledge, expertise and understanding. You know, some of the things we're looking at on operational risks are pretty complex and not everyone understands that they're there and need to be managed.
Well, let's see if we can't bring a little bit more clarity to those operational risks and spend 1 to 2 minutes on each of those in turn. Elaine, the first one that you highlighted was the treasury function. Could you expand a little bit more on the risks associated with that?
Yeah, sure. So here we're thinking about the fact that when capital's allocated to an investment strategy, you know, it will be used to buy securities, but there will also be some excess cash that could be held in the portfolio. Is there an opportunity lost if that excess cash is just sat within a custody account and not earning additional return for the fund? So here we're thinking about, can an effective treasury function help our clients to better manage that excess cash in the portfolio and basically put all of the assets to work in the portfolio much harder?
The second item that you highlighted was fund liquidity. Nick, this is a topic that's in the papers every other day, isn't it, for certain high-profile situations? But perhaps you could expand on fund liquidity and how we think about that risk.
So if we're looking explicitly at a pension fund, there's some obvious fund liquidity things that need to happen. Pensions have to be paid, so trustees need to make sure there's an amount of cash to be able to do that. There are then other levels of liquidity required. For example, you need liquid assets, which may be used for collateral, for derivative contracts. So all in all, there is a framework whereby you need to assess the cash that you need and also the assets that you might need in certain market scenarios. But we also need to remember that a large driver of pension fund returns is the liquidity premium. So the other side of that is you need to assess how much liquidity you need, but also how much illiquidity you can stand to generate better returns to reduce the cost of pensions for your pension scheme members.
Both good points. Elaine, the third topic that you mentioned, which was cost and tax transparency, is a topic that's near and dear to my heart. Nick, as you know, the regulator rightly focuses on risk, but cost transparency is a rightful growing area of focus in the market today. We're very supportive of the growth and focus on cost transparency because trustees need that information to be able to manage those costs. Yet we do see areas that are falling outside of the radar. Despite great initiatives like the Cost Transparency Initiative, MiFID II across Europe, there are examples of items that are not covered on these expansive cost templates. One of those areas is investments in pooled funds, where a pension scheme may invest in an inappropriate pooled fund structure. And by doing so, they are penalized on the withholding tax rates on dividends. Now that might seem like a pretty small area, but when you add it up, we estimate that pension schemes who do invest in these types of pooled funds are losing approximately 0.33% per annum of return in performance. And when you consider that active managers are attempting to outperform a benchmark by 1% per annum, or indeed in some cases, a scheme may be invested in funds attempting to track the market return, that's a very substantial component and puts pressure on trustees to justify if they are providing the best value for return to the members of their scheme. Elaine, the fourth area that you mentioned was trade errors. Could you expand a bit on that?
Yeah, of course. Trade errors will happen whether it's by human error or system failure. And typically, you'd expect your investment manager to pick up on those larger errors. But for some of those smaller trade errors can be time-consuming and quite complex to manage. But the reality is that those smaller trade errors can mount up, and we've seen for our clients that it can be a cost drag on the scheme. So what we think is actually you could put in place a contractual obligation with that investment manager, and that would really serve to report on those trade errors, make sure they're refunded, but really importantly, take steps to ensure that they're not repeated. And that just alleviates some of the operational risks that we've talked about and also enhances the returns for the scheme.
Okay. And then the last point you mentioned, Nick, I'll ask you about this, counterparty risk. How do trustees think about this topic and consider this?
Yeah, there are times when running a pension fund where assets of the fund pass out of your control to be with other people or entities, or you write contracts where there is value in those contracts. And what is important is that trustees ensure that the value of those assets and the value of those contracts still accrue and remain safe for their members. So that is managing counterparty risk. And to do that, you need to look at the strength of the counterparties and also the strength of the documentation which binds you and your assets and your right to receive the returns of those for your members. So what is needed is a process where you do that and that you are able to actually react to changes to strength of counterparties and strength of market conditions and changing market conditions.
Thank you. So we've covered 5 topics here. We'll be taking questions shortly on these topics. But before we go to questions, Elaine, could you wrap up on the third item that we said we would discuss today, which is how is technology being applied in today's market to address the 5 areas that we spoke about?
Sure. As we've been discussing, there are a number of demands that are now on our clients in order to know more about their funds and the associated operational risks. And what we've seen with our clients is if they have multiple funds across their portfolios, then there's an extra demand on their time and resource in order to try and manage those challenges. But what we found is with the advancement of investment platforms that are supported by technology, this can really help alleviate a number of those challenges that we've been discussing. So in particular, if an investment platform also has the support of a risk management function, then that really helps alleviate some of the pressures for our clients, because that risk management team are dedicated to supporting and monitoring all of the risks that we've discussed, be it investment breaches or trade errors. If that investment platform can also build efficient fund vehicles, then that's a huge help for our clients, not only from a tax efficiency point of view, but also it gives them further transparency and control of their underlying portfolios. I'd also note the scale of investment platforms. By that, I mean, to your point, that our clients can then benefit from negotiating lower rates with managers and counterparties. And then finally, it's an easy topic to talk about, but just having data that is consistent and also easily available in the one place has proved to be really useful for our clients.
Well, I'd like to bring our session to a close now. We've covered what we believe great governance looks like, 5 key areas of operational risk that we think requires more focus. And Elaine wrapped up with a view on how technology is being applied today to address those areas.